You're an agribusiness executive navigating an increasingly competitive market while trying to grow your company. Mergers and acquisitions are pitched as an accelerant to growth, but many M&A deals destroy more value than they create. Welcome to the Pacesetter Pod, where we explore and reveal the perspectives, insights, and approaches for successful mergers and acquisitions. Here's your host, the Integration Pacesetter, Joe Mosher.
Hello and welcome to another episode of the Pacesetter Pod, where we focus on addressing the strategy, growth, and performance challenges facing the leaders of food and agribusiness. I'm your host, Joe Mosher, and I really appreciate you choosing to spend your time with us today. Today, we're going to be talking with Mike Taylor. Mike is a founding partner at Midwest Growth Partners and has been working on M&A transactions and in private equity since 2003. So 2 decades of great experience, lots of deals, lots of experiences that we're going to be able to tap into and learn from today. A little bit about Midwest Growth Partners. They're an Iowa-based private equity fund, and they're responsible, and these numbers may not be right, so Mike will update us here in a minute, but they're responsible for the deployment, management, and return of more than $325 million of private capital. Midwest Growth Partners, or MGP, let me just get out of the way now because I tend to shorten things up. MGP leads and participates in transactions to fund or make possible succession planning, liquidity events, as well as making growth capital investments. And they really focus on underserved rural communities. And as part of that, the lion's share of their work really does invest capital into ag supply chain and ag-related businesses and industries. So something I've been looking forward to for a long time. Mike and I have known each other for a couple of years now. Mike, thank you for joining us today and welcome to the Pacesetter Pod.
Hey, thanks, Joe. It's a pleasure to be here. I look forward to the conversation and honored that you asked us to be part of it today. So looking forward to it.
Yeah, likewise, 100%. So I was really excited earlier this year, Mike, when we reconnected, kind of talked our books of business, what was going on, what we were seeing, and talked about the show, and you agreed to come on. So this is pretty exciting. And there's a lot related to private equity and agribusiness that I want to talk to you about. And so it's going to be a pretty sweeping and I think very interesting conversation. But before we do that, maybe to get us started, can you just give us the broad strokes on your background and how you arrived at a place where you are so personally and as a business committed and focused on supporting the growth of domestic ag supply chain businesses?
Yeah, happy to do that, Joe. So I'm a native Iowan, grew up on a family farm operation in southwest Iowa. We raised corn, soybeans, cattle, and hogs, and really always had a passion for agriculture all through childhood and school, involved in all the typical ag activities like 4-H and FFA and other things, and enjoyed working on the farm. Always wanted to be involved in agriculture, didn't exactly know how. Our operation wasn't large enough to support another full-time employee, much less someone that wanted to have ownership or have some kind of entrepreneurial involvement. And so went to college at Iowa State University in the College of Agriculture there, and had a degree in agriculture and a minor in entrepreneurship. And it was really a kind of an aha moment for me. It was, I would say, a time where I figured out that I could blend my intellectual curiosity and some of the academic learnings with my entrepreneurial passion for agriculture. And so if you put all that together in kind of a pot and stir it up, I would say that's what I get to do today, now 20 years later. So it's been a real privilege. The journey along the way has had a couple of stops, including in businesses that aren't ag-related, which is how I got my start in M&A, which was a retail pharmacy roll-up that spanned almost 18 years before we exited. And so kind of a long way around the barn, Joe, but by and large, always been based here in Iowa, which, as you know, has ties to food and agriculture anywhere you look.
No, I think it really is. And we'll get into this, but one, it's an asset to the industry, but also personally very fulfilling, the idea of being able to blend that intellectual curiosity, the idea of wanting to start and build something and be involved in the growth of businesses and then be able to do it within agribusiness, right? And, in some of the best dirt in the world right there in Iowa. And so that's a real gift.
It is. In fact, I had great experiences throughout undergrad interning for agriculture titans like John Deere, DuPont, Cargill, all great experiences. I loved my internships, met a lot of great people, but it also solidified in my mind that it wasn't exactly what I wanted to do. And I would also say, and I'm sure we'll get into this, it's never quite a straight line getting from A to B. And I didn't grow up with some vision of being in the private equity world. I know some people actually probably did. If you grow up on the coast or grow up in money centers, that's probably common lingo. It wasn't on a gravel road in southwest Iowa. And so my journey has been a little jagged in terms of finding the spot, but all those experiences along the way, I think, have helped create what is now our fund and our strategy and our culture, and I'm really proud of that.
Yeah. Well, you can only connect the dots looking backwards, right? So you can tell a great story. I do the same thing about how my career makes sense, though every single zig and zag, it seems like, what are we doing next? Why this? Why now? But that's so the idea that growing up where you did, not having a vision or an aspiration necessarily be a PE guy, maybe not even know what private equity was, let's start there. So we had a recent conversation with another guest where we actually did talk a little bit about private equity and provided sort of the PE 101. But I think it would also be good to reiterate that here. This will be a review for some people, but it's really important that we level set for many of the others, that we throw the term PE around so loosely. And I'm fairly convinced when you dig in, not everybody is actually very clear on what it means or how it operates. So walk us through that. What is private equity? And what does it actually do? Let's just align on the terms: a fund, an MP, an LP, an investment thesis, a holding period, all these things. Just kind of give us the high level run through so we can go into this informed.
Yeah, no, it's a great question, Joe. And, candidly, it's one my wife and our 3 kids get frequently, and I'm not even sure they know how to answer it sometimes after 20 years of doing this. The easiest way to describe it is if you think about everything you read in the Wall Street Journal or any publication about the public markets, right? So you're aggregating investor capital and you're investing in stocks or bonds or different funds. It's really a similar concept, but it's in the private markets. So we go out as a fund manager and we solicit investment from both institutional capital providers, which are aggregators of capital, or even nonprofits, banks, insurance companies, high net worth folks, family offices, people that are looking for exposure to the alternative asset class, and within that, the private equity allocation for them. So they may be looking to be more heavily weighted to venture capital or more heavily weighted to private equity or maybe private debt. Whatever their investment protocols are, we, along with other funds, offer up what we think is a good thesis or a strategy. And then in terms of sizing, we try to align with them. So it doesn't fit for everyone. Some people want to allocate to financial services or technology or business services. But if you want exposure to private equity, you want exposure to rural markets, and you want exposure to food and ag investments, we're a pretty good fit. So when I say we, it's MGP, we would be the fund manager or the general partner. And then we would attract capital from investors. They're the limited partners, and an LP. And all that really means is, as an investor in the fund, their exposure is capped at whatever they committed to. So if they invested a $1 million amount in our fund, the most they could ever lose in this example would be $1 million. They're not on the hook. They're not signing guarantees. There's no pull through. So it's a way for them to kind of cap their exposure, if that makes sense. Mm-hmm. And as part of that, then they pay us as the fund manager to go out and search for opportunities and deploy their capital in businesses that we think we can grow and improve and show a good return. So kind of part and parcel with that is the fund life. So when you make an investment in a private fund like ours, you're committing to a 10-year window. And so we like to think about those in 5-year chunks. The first 5 years is really the deployment of that capital, and the second 5 years is the harvest. So in the middle, we're trying to do our best to grow, professionalize, and increase the value of each of those businesses so that when we do harvest or exit, we're obviously returning more capital than we deployed. That's obviously the goal. So it sounds complicated. It sounds, I think, confusing to some. But when you break it down at its simplest form, it's aggregating capital that wants exposure to a specific part of the asset class, and then picking a manager that aligns with your kind of vision, values, and culture. And that's really how it all comes together.
And I think another key difference versus trading index funds or just going into a publicly traded market and in the private equity space, depending on where you're at in that cap table, you also have an opportunity to not just buy and hold that business because you think the long-term prospects for profitability are there. It's actually influencing the growth and providing that kind of expertise and guidance. And some of the things we'll talk about, you actually can get a position in companies where you see a lot of upside and then influence that upside to the benefit of your investors. And I think that's also something else I want to flag that we'll come back to later, is part of the model with private equity is an obligation for the return of capital, which then, of course, causes the need to have an exit and a known exit, right? It's not a surprise. The fund it's not an evergreen fund. It's not permanent capital. And so we'll come back to that later because that's one of the things I think sometimes people get hung up on is, well, they bought us just so they could sell us. Well, or because that's the way the investment is structured. Investors may not necessarily want to keep their capital in XYZ company indefinitely. And so I think that's something we should come back to. But can you maybe also then, you mentioned venture capital or VC. How would you differentiate private equity investing from venture capital? Does it look different in terms of the companies they're invested in, the structure of ownership or equity? How do you pull those two apart?
Yeah, it's a great question, Joe, and it's one we talk about frequently because I think there is this misconception out there that VC and PE are the same thing, and they're really not. The reality is, and there are nuances here to how you define each of those, but broad strokes, categorically speaking, private equity investors typically are looking for businesses that are cash flowing, have a good history of profitable operation, have a good management team, good diversity amongst customers, suppliers, et cetera, and have a growth story or a need for a succession plan and liquidity or maybe even an acquisition financing. So there's kind of that stereotypical growth capital mindset. On the VC side of the world, venture capital, and again, broad strokes, but generally those companies can range from idea to pre-revenue. Maybe they don't even have a customer yet, right? So it's very much a different life stage, very much a more fragile business. You're investing with the idea of material growth predicated on some kind of early indications or early customer feedback, but very much a different profile. Typically, there's no balance sheet there. Typically, there's no cash flow, usually negative cash flow. And so the mindset is just different. On the VC side, you're investing in, call it 10, 12 companies, but you're expecting more, a majority of those, candidly, will fail for one result or another. But the outcome of the ones that don't fail will be so disproportionately positive
that
it offsets the failures. And so that's how they generate their return. On the PE side of the house, we go into every deal expecting them to succeed at some level. There are varying levels of success, including maybe even just getting out for what you put in it. But underwriting any of those as zeros, would be a cardinal sin of a PE investor. So it's just a different mindset. Neither is right or wrong. It's very much just a different approach.
Well, I think it also is going to attract different investors, and it's a different level of rigor and maybe not rigor. It's a different lens through which you look at the business, right? One is you're placing big bets on people and ideas, if I could be so reductive. And other ones you're betting on the future with a track record you can look at to see here's how the business has performed over time. And now let's analyze what does the future look like within the context of what they've performed in the past and how could they do that again. So I think that thanks for walking us through that, because I think it is, they get bundled sometimes. And I think they're fundamentally very different capital inputs to the industry.
They really are. I mean, said another way, I think you hit it on the head, but said another way, on the VC side of the house, you're underwriting the future, right? You're underwriting the potential of growth with certain assumptions around execution. With PE, you're really underwriting kind of a TTM or historical cash flow with an eye on the future, right? So It's kind of baseline underwriting, maybe with some negotiation for upside. But on the VC side of the house, you're kind of underwriting everything forward-looking. There's really nothing on a TTM basis to underwrite. So it is a different mindset, different skill set. There are examples of funds that have done well, kind of managing both, but typically you'll see managers kind of migrate to one side of the equation or the other.
Yeah. Which then, for the folks that were kind of listening to the first part, when you talk about wanting exposure to an alternative asset class, wanting exposure to agribusiness, this does fit the need from a portfolio mindset of your investments. You could have a little bit in sort of the boilerplate equity markets and index funds. You could have in bonds. You could have some in cash. You could have some in highly speculative, high risk, high reward VC. And you've got some in the PE space. It does kind of fit an overall investing strategy for whoever's putting that capital up. So Mike, let's talk about then the PE trends in agribusiness. And this is a little bit dated here, but I continue to think it's a very interesting statistic. So I was reading a report from an iBank, I think it was late 21, early 22. Then they indicated that at the time they saw nearly 1/3 of all M&A transactions within food and ag. And this would have included very large deals down to sort of micro transactions. 1/3 of all of them were PE backed or had PE capital coming in, right? So maybe the private equity fund didn't necessarily lead it, but in some way, shape, or form, that was where money was coming in. So a significant portion of all the transactions within the space in a given year. And then the analysis further said that they estimated that 20% of all those deals were add-ons, meaning that a PE firm had already made their sort of beachhead or platform investment and was now moving to extend their footprint and was doing roll-ups, which again speaks to this is not flavor of the month. This means that there is significant capital rolling in and more capital is following it. And so I think you want to be careful not to overstate how much PE is maybe disrupting or turning the industry inside out. But the idea that it's not a big deal is also, I think, incorrect. So with all that said, what trends are you seeing in the space, given the number of potential deals you look at? Is PE active in agribusiness, or are you on an island kind of leading the charge? How do you see it?
Yeah, great question. And, I can't speak to those statistics specifically from the iBank report, but, a couple of observations that come to mind for me. I mean, I wish I could sit here and tell you we're the only folks chasing food and ag sector related deals, but that's certainly not true. I do think, looking back 10 years ago when we started the fund, I would say there were definitely fewer players looking at the same deals because food and maybe more broadly agriculture, I think sometimes would get parked under the investor red flag list of, commodity swings, right? And so I think they would kind of get a little nervous and think, that's not really a fit for us. But as the world has matured in the food and ag sector, and candidly, with events like COVID and others, I think the world has really taken a fresh look at food and agriculture and realized this is the one industry that we literally cannot live without, and something that touches most humans 2 to 3 times a day in terms of nutrition. And so, I think for us, it's always been kind of inherent in our approach because we've grown up around it, we've lived in it, worked in it. But I think others are attracted to it increasingly because of some of the resiliency factors that we've observed here, especially coming out of the kind of the post-COVID shock. So, I can attest to the deal volumes. They're certainly there. The connotation around, private equity being, heavily involved in business roll-ups or acquisitions. I mean, I would suggest to the listeners, private equity should really just be considered another capital provider. So no different than a business approaching a local community bank or even a regional or a national bank for debt financing. We're much the same in that we're an equity financing partner that may look and be structured differently than a senior lender, but conceptually, we're a financial tool, just like a senior lender is, to help a business grow or achieve their objectives. So that's maybe something to think about as you go about the rest of the conversation, because we're really not out looking just to buy and build or create moats around businesses, but to really be a partner with those operators, whether it's debt or whether it's equity or a combination of the two. We try to find the right fit and help them as best we can.
So volume is there. Any insights or thoughts around deal size? Are we seeing that they're holding steady within a certain constrained band of this is the size deals are getting done, or size businesses, or are they moving up the chain? Thoughts there?
Yeah, a couple of things. I'd say definitely volumes are there. So by way of example, 10 years ago when we raised our first fund, we were telling investors in our pitch meetings we wanted to see 100 opportunities a year and invest in 1 or 2. Last year we saw 800 and we invested in 4. And every year since we started, deal inflow of deals has increased. So I think part of that's the market understanding who we are and what we're looking for. But part of it's just realization there are a number of opportunities out there that need capital partners. So yeah, with an exclamation point, I would say deal volume is certainly there. And I think that's part of the reason you've seen more folks come into the food and ag sector, because they've also realized that. In terms of deal sizing, Joe, it really comes down to what your investment thesis is and what kind of your mandate is, right? So could we go out and find exclusively deals that are kind of 1 to 3 million of EBITDA in terms of enterprise? Sure, we could. Could we go out and exclusively do deals that are 20 to 25 of EBITDA? Yeah, we could. But it's really the range that I think is important. So the small stuff we see would be kind of EBITDA neutral, and the large stuff would be in the 20s. Categorically for us, if you think about our fund size, we're currently investing out of Fund 3, which is 170 million of committed capital. So if you break that down and you think about a mix of equity and debt and portfolio composition in terms of number of companies you want to manage, ideally we're looking for businesses with 5 to 7 million of EBITDA. And that typically kind of translates to an enterprise value that makes sense for us from a sizing perspective.
Poorly executed mergers and acquisitions destroy more value than they create. They can set your company back years. To defend your firm's position in the marketplace, you need access to the leading practices that unlock the greater potential of your people, processes, and systems. If you are undertaking a company transformation or pursuing an acquisition as a vehicle to grow, set up a call with Joe by visiting www.moshercg.com.
Yeah, it's a good classification or clarification, because it's probably an unfair question to ask what is the average deal size out there, because your investment thesis guides you towards deals that are within the range where you think you can add value, where you see there's opportunity for incremental value creation. So thanks for that. Not asking you to necessarily talk your book or tell us where you guys are looking at specifically, but generally speaking, where are you observing hot spots in investment along the ag supply chain? For a number of years, it was the small mom and pop ag retailers getting rolled up by the bigs. Or you see other areas where small specialty feed mills are become a target. But I'm wondering what you all are seeing these days. Are there any hotspots that are attracting a lot of attention?
Yeah, I think it's a great question, Joe. A couple thoughts I would share. One, and this isn't like it's a big secret, but labor is a challenge, especially as you think about skilled labor in a rural market in an ag setting. And so we think anything on the investment side that solves for that labor challenge is pretty interesting. We have some exposure to that space now, but I think you'll continue to see that trend be very positive. And it's kind of a twofold thesis. One, it's solving the gap for finding labor. So that means, automation, autonomy, technology. But then on the flip side, even if you have the labor, some of these tools can allow that labor to do more with less, right? So we feel like it's kind of a win-tie. We can solve for a gap in the labor pool, but we can also increase efficiency of the labor that you have. So that's one investment thesis that we're focused on. And then you touched on ag retail being consolidated by the bigs. And I would say on the ag processing side, we've seen opportunities where especially in food grade oil refinement as an example, where if you can stay in the value chain and be kind of below the fray of where the bigs want to be, in other words, either volume or niche products, or maybe it's a certain footprint. For us, we think there's opportunities to exploit some cracks in some of the bigger processors that don't want to come down market. So finding your lane where you can really make an impact, and last but not least, investing in businesses with great leaders and people that are entrenched in the business and wake up thinking about how to make things better, how to grow, how to take care of the customer, and so. Those are things we're always talking about within our investment committee.
Yeah, for sure. I mean, private equity investment doesn't necessarily mean that the existing leadership team has to leave the business. The ownership structure may change, but in many cases, ideally, you cut that check with an agreement that everyone's going to stay put, right? And I'm thinking here too about, you talked about the ag processing space and food grade oil refining and staying below the fray. Just thinking out loud, but the long-term prospects for that space in light of how much new capacity, crush capacity and processing capacity is going to divert some of that, the oil seeds and the oils from that are going to be diverted to sustainable aviation fuel as opposed to food applications. And so what opportunity does that create if there's not as much new investment into state-of-the-art oilseed processing facilities that might provide some interesting opportunities for the traditional players, regardless of their size or scale. So interesting. So let's talk about kind of where I hear a lot of the conversations go, and it's the PE impacts on agribusiness, or really, you can say probably on any industry, but agribusiness is what we talk about here. So there's a lot of challenging perspectives related to PE generally. I think this creates some concern among the incumbents and the traditional operators that see private equity either as a competitive threat or just an outright threat to their existence. And, it's certainly not helped. We talked earlier about how PE and VC can get private equity and venture capital get lumped together. And we've seen all the flood of the venture capital money flowing into ag tech and other quote unquote industry disruptors, right? And then you've got kind of that long tail reputational liability of the previous iterations of private equity. I'm thinking primarily things like, LBO or leverage buyouts back in the 80s and 90s, where you buy a business and you kind of bury it in debt, right? Or the buy and break model. We're going to buy this and we think there's more value in the parts of the business than in the sum of the business. And so when such and such investment firm comes in and buys you, it's, now it's an auction. and we're pulling the scarecrow apart and my legs are over here and my arms are over there and everything else. And so with all that being said, PE is not a monolith, and it's very reductive, I think, to celebrate private equity or condemn it writ large. You need to look at it at more of a localized level or even a firm level. But what would you say are the underappreciated upsides of private equity? If we know what all the real or perceived downsides are, what do you think are the underappreciated upsides of it?
Yeah, and I appreciate the question and the pretext that you provided, Joe, which kind of made me chuckle. I joke often with our management teams when we're getting to know them initially, even before we make our investment. And we talk about these things very openly because there are these preconceived notions of kind of all the bad connotations of private equity. And my joke to them typically is, hey, look, your expectations are so low that I have nowhere to go but up. So this is good for you and me. But, joking aside, the reality is, like in any industry, one bad actor can create a lot of pain for all of the folks and the good actors. And so, I would say we have taken a very personal approach to the market. We share our story whenever we can on venues just like this, or, even better in person, and really tell our story. And that is, hey, look, we want to come alongside you. We are not here to run the business. Typically, if a private equity investor is getting involved at that level, something's gone wrong, right? That was not part of their thesis. Private equity funds aren't staffed to deploy internal teams to run portfolio companies. That's certainly not our thesis, never has been and never will be. We want to back the incumbent. We want people that have forgotten more about that business than we'll ever know. If we find that team and we capitalize the company appropriately, we feel like that's a great foundation for success. People that wake up every day thinking about how to improve their position for their customer, for their company, and ultimately for us as investors, we're aligned on that, right? And so, one of the ways we try to diffuse that is upfront, have an open forum. We love to field questions. We love to talk about concerns they have. I think with a quick Google search or two, a target company can do a little background work on us, and they can realize that we've been in the space for a while. We've had some good outcomes. And if they want to vet us with existing portfolio executives, we always welcome that. And so that's a quick way to diffuse some anxiety as well, is let folks pick up the phone and talk to leaders of our other portfolio companies and let them kind of ask their own questions without us in the room. And we think that's a good way to also give them confidence in those people. So that's a long answer to your question, Joe, but I would just say whether it's banking, whether it's telecom industry, whether it's energy, you can look through the course of history and find lots of singular bad actors that create headwinds for the rest of the folks trying to do it the right way. And that's not going to change. I think what we can control is how we carry ourselves, how we conduct business, how we source and execute deals. And so that's really the MGP way.
Yeah, I love that. Thank you for that. I think to also build on it, your idea of one bad actor, sometimes I ask the question when folks talk about, PE's coming in and turning these companies inside out. And I say, okay, who, right? You ask for the example. And sometimes you realize it becomes anecdotal and no one knows the name of the company or they can't tell you.
Yep.
One of the things we need to think about too, and I bring this up again simply because it comes up so often. It's kind of going back to the leverage buyout of burying a company in debt and or buying and breaking it up. The investment thesis around the buy and break model was that there was more value in the individual parts than there was the summation of it, which may have been very true when you come out of an era of conglomerates, where overexuberance at the board level and a willingness of banks to fund that growth, you had a lot of companies that had divisions that there was no net benefit to having these types of very different companies coming together. And so actually pulling them apart and providing a singularity of vision and of strategy and ability to execute actually did unlock a lot of value and unlock a lot of potential. And so then you actually did create value by disaggregating them. Certainly in the lower middle market space, there's not a lot of examples that I couldn't think of an example at all off the top of my head where I look at that company and say, man, if you made that company into 3 companies, how amazing would it be? And so I think it's important to challenge those assumptions. One, do we have evidence? Can we point to a bad deal in the last 2, 3, 5 years? And 2, looking in the mirror and saying, okay, is our business actually more valuable if we break it up? If we don't believe it is, if there's a rationale around why this all makes sense together, then presumably more people would agree with that than not. So that's there. So the one thing I did want to ask you about, though, because I always, again, I'm speculating here. I don't have a data point to point to, but I imagine as a GP, as running a private equity fund, there are times where the hold period and that countdown to returning capital is ticking, and you own a business that you frankly want to continue to own. So is that a conundrum for GPs and LPs and private equity generally? And if so, I mean, how do you reconcile that where you're kind of forced to divest or sell a business to a strategic investor or otherwise, where you say, man, all things being equal, I'd love to just park our capital here for another 10 years?
It's a great question. We often have the phrase internally here, you can't fall in love with them. And that doesn't mean that in the interim, you aren't in love with them and you aren't trying to help them and try to improve their position. But the reality is, it is a stark reality that we manage finite life vehicles. Typically, they're 10 years. They could be extended in some cases to 12 or maybe even 15, depending on your governance. But the point is, we're not forever owners. And so I think the first thing you have to do is accept that, acknowledge it, accept it up front so you know that there aren't any surprises. And we also have to convey that to our targets. So as we're courting them or talking about a deal, I want them to know up front, we're not a forever owner. And so you might have just come out of a 40 or 50-year family hold. As a 10-year vehicle, the best I can offer you on average is 5 to 7 years. Mm-hmm. And so that is met with a variety of reactions, as you might imagine. For some people, I think they think, oh, well, that's good, because if we hate each other, then at least we can move on after 5 years. And those are the minority, obviously. For others, it's scary because they say, well, boy, we're just going through this transaction. I don't want to do this again in 5 years.
Right.
And whether it's us as a buyer or anybody else, there are very few truly permanent capital structures today. They do exist, but they would be the exception, not the rule. And so I think, the old buy and break, as you were talking about, I would say the market was much more inefficient at that time. And you fast forward 20, 30 years, and with the speed of technology and the speed of information flows, I feel like those things are much less likely to occur going forward. I think buy and build is a much more kind of standard approach than buy and break. It certainly is an MGP approach. And if you look at our portfolio, buy and build, we think, is a great way to create value and unlock value for our investors. I would also say, Joe, investing in a family business that's been held through multiple generations of family, been run a certain way, managed a certain way. In some cases, there's value to unlock there, just getting the business into an institutional investor mindset, whether it's reporting, governance, management makeup, et cetera. So there are lots of ways to create value that doesn't have to come from a breakup, if that makes sense.
No, I think it's a very fair point. The work that we do, we predominantly serve companies in the post-M&A integration phase. And what's really interesting is I think if you asked folks that we had worked with, and this is not a reflection of our work necessarily, though I think we do a great job, but there's often just as much value creation that comes with the need to look at your business differently post-deal as there was from the incremental value of adding the new business, of bringing them together, and the synergies that you gain, or the incremental value creation is because once you do kind of go through a big transaction, you suddenly have different people in the room. You have different level of expectations, whether it's from a bank, from your investors, from your ownership. And suddenly you start to look at things like, what are our core business processes? How effective are they? How efficient are they? How much do they generate value that translates into revenue and profits? Organizational structure, operating models, how do we make decisions? How adaptable and agile are we? Use of technology. You talked about automation earlier, but even enterprise resource technology, where you just say, hey, Peter Pan, we're a 75-year-old business. We got to get off Excel. We got to stop running our business on Excel. And so I do think that sometimes just that mindset shift that comes with the transaction does add much more value than I think people expect. They look at it first as this is going to be additional work. It's going to be additional pressure. We have to change the way we operate. And that's a cost of doing the transaction. But on the backside, they say, well, that was actually a fundamental change that kind of helped us accelerate into the next S-curve of growth. So I think that's a really important point.
Totally agree. And I've got case study after case study of deals we have done. So not just some academic thesis, but something we've done in real life, where we stepped into a business, either a minority or majority position, and helped them professionalize the company. So as an example, we made an investment in a manufacturer. When we were doing diligence, the financial reports they provided us still had the paper, the paper that came off the printer, you tear off the sides, like it was that old.
Super satisfying.
And it was even like a post-Y2K thing, but they had to handwrite the date on the financials, which doesn't instill a lot of confidence when you're talking to bankers or lenders. The point in that example, though, Joe, is we held that business for almost 7 years. We bought two more companies just like it. We combined the best of the three in terms of ERP, CRM, accounting, audit procedures, built out a full management team that otherwise was pretty thin, pretty fragile. And eventually we sold that to a business with over $1 billion in revenue. Everybody kept their job. All the plants are still open. They've been able to grow materially because they have access to new channels that we couldn't provide. But the point in telling you that is those businesses individually couldn't have sold themselves to that buyer because they weren't ready. They didn't have systems, people, processes in place. And so that 6 years of investment by us, beyond just the money component, really was kind of foundational to putting them in a position to really have a successful outcome for their investors, for their employees, and ultimately for their customers to enjoy a better service in the end. And so that's just one example, but I could go on for hours of stories like that are very real. And if you think through that lens, I think it helps kind of break down some of the barriers and misconceptions about PE investing.
Yeah, and a fair point too. I mean, it's not just the value that's created during the holding period, that 5 to 7 year on average that you talked about. In many ways, that 5 to 7 year holding period is a bridge to the much bigger value creation that comes later on when it transitions again, presumably not to another company that's going to hold for 5 or 7, though that could happen. It depends, but it really is a bridge to much bigger things. So, Mike, we've kind of nibbled around the edges here, and you've talked a bit about the number of funds that you all have and how you got into it. But I think it behooves us to spend a couple of minutes just talking about Midwest Growth Partners more specifically here before we close out today. So you mentioned that it was formed in 2013, so happy 10-year anniversary. You're on fund number 3. You talked a little bit about your investment thesis and where you focus, but what else would you want listeners and the market generally to know about MGP?
I probably did a poor job explaining maybe some of the origins, Joe, so I'll back up a step.
Please.
In our world, there's really kind of two trains of thought. If you have the capital and you have a committed fund and you're managing that fund, then you're a private equity investor. But if you don't have the capital and you still want to go buy businesses, then you're an independent sponsor. That's the kind of common lingo. And so we started as independent sponsors. And what that really means is you find a business or you have an investment thesis that you like. You might sign a business up or agree to terms and then kind of hit pause and go raise the money. So that means borrowing, investing, or bringing co-investors in. And that's what we did. So my partner, Joe, and I started doing that in 2006 and bought a number of businesses in distribution, manufacturing, some real estate services. And over time, what you realize is it's really inefficient to find the business and then go find the money. And candidly, one of our investors, to their credit, said, have you ever thought about raising a fund so you have the money and then go find the business? And we'd talked about it. But again, growing up in Iowa, both of us grew up on rural farms. That wasn't something that was top of mind. And so that's when we joined forces with John here, and he brought more of an institutional mindset, helped us kind of formalize the strategy, and we raised our first fund in 2013. But the genesis is, and I'm proud to say that investor has since invested in all 3 of our funds, which is the ultimate compliment in our world. But I guess I share that to say, Joe, as independent sponsors, we've been on the other side of the table. We're a small business owner. We're operating the company. We're dealing with kind of the day-to-day minutia of the business. And then in 2013, flipping that switch to being the financial partner and having a committed fund. And so I think, to your point on connecting dots, looking backwards, I think that has uniquely qualified us to relate to the market that we're trying to serve. So when we sit down across the table from a family business owner and we talk about what a transition might look like, what a succession plan might look like, we can wear our operator hats because we've been in their shoes before. We can also wear our capital partner hats because that's what we do today. And sometimes you have to understand both camps to find a deal that makes sense and that is agreeable for both parties. So that was really a great training ground for us from 06 to 13. And I think a nice transition into managing committed funds. That first fund was $41 million of committed capital, which is pretty small by private equity standards, but it was really a proving grounds for us. As a first-time fund, it was, okay, we understand your thesis, we understand your market, go out and prove it. And I think we did that, which helped us raise Fund 2 in 2018. That was a $113 million fund. And ultimately, then in 2023, closing out our fundraise for Fund 3, which is a $170 million fund. So back to that 10-year vehicle conversation, if you think about the fund manager's world and the five-year buckets of deploying and harvesting, the idea is over time that as your funds are staggered, you're never in the market without money, if that makes sense. And so the idea is we always have access to capital, and we're always out sourcing and cultivating relationships to find the next opportunity, whether it falls into Fund 2 or Fund 3 or a future Fund 4. Really, that doesn't matter for today's purposes. It's just about making sure we're carrying ourselves away in the market that people respect and that they want to do business with us. And when they have a capital need, they'll think of us first.
Yeah, it's like that laddering approach, right? Yeah, you're always in the market. You're always on the buy side. You're likely always somehow exploring or maybe even executing the sell side. And you're also in the middle space there having a look. So it's a good strategy to keep all those muscles warm as well, right? You don't want your ability to buy a business to atrophy because you've been so busy running a business that you forgot how to buy one. And God forbid you don't know how to sell it either. So.
That's right. No, that's right. I think I tell friends that for a person who is constantly wanting to learn and who enjoys buying and selling and kind of enjoys the thrill of the hunt in terms of sourcing, this is a dream job. And the best part is working with people that we develop relationships with over time. And, it's a lot of fun to look back on some of those success stories that have benefited the communities, the employees, management team, and of course our LPs, our investors. And it's been a fun 10 years. We'll look forward to the next 10 years.
Great. Yeah, and I think, as you said before, having investors become anchors in every one of your funds where they continue to come back and subscribe again and bet on you again and back you again is the ultimate compliment. And we don't want to say timestamp these episodes too much, but raising a material fund in 22, 23 wasn't necessarily the ideal time to raise capital in many ways. And so the fact that you also had a subscribed fund and return investors in that time, I think speaks volumes to how you're perceived and how you've performed in the marketplace. So congratulations on that success, and absolutely looking forward to watching the next 10 as well.
Well, thanks, Joe. I appreciate you saying that. It's really a testament to our team here at MGP and to our portfolio companies that work hard every day. And with our LPs, we've been very fortunate. Our investors have been loyal, they've been patient, they've been steadfast. And, we really couldn't ask for a better group to work with. So we've been very lucky. Well
said and fantastic. Well, Mike, great discussion, great insights, a lot of value. I'm not going to keep you here all afternoon because I know you got checks you got to write, right? So I did want to just take a moment to let folks know that Midwest Growth Partners, you can find them online at mgpfund.com. The whole team is out there. You have access to Mike, access to his partners if you want to get in touch. Great information on their current and I believe past portfolio holdings as well. So a sense of where they've invested and how they've performed. So if you want to learn more, that's all there and they're available and accessible to you. But Mike, I just want to close out by thanking you once again for taking the time and being part of the Pacesetter Pod today.
Hey, Joe, really appreciate the opportunity. It's been a lot of fun. I have to disclose this is my first podcast ever. So appreciate you being patient with me as well. It's been a great conversation, and hats off to you for hosting different folks in the space, and look forward to staying in touch.
Thank you for that, but not at all. I feel like you're media trained, so I'm going to...
Well, as my wife would say, my face was built for radio, not TV, so this works out pretty well.
Video off, audio on. Same here. Very good. Well, with that, we'll close. Thank you, as always, to our listeners for tuning in today. Remember to like and subscribe to the Pacesetter Pod wherever you get your podcasts. And you can find me, Joe Mosher, on LinkedIn. Or if you need to get in touch, you can set up a call with me directly at our website, moshercg.com. Thank you for listening. Have a safe day.
This is thepodcastfactory.com.